If you're looking for shorts in a market like this, do you worry that some things might fly away from you before you can start to turn a profit?
Yeah, certainly right now, when you see this type of market action, the names that are highly speculative are maybe not the best short. So you really have to pay attention to the technicals of those, such as what is the existing short interest? Because if it's difficult to get borrow, that means that it's, especially in this type of market where the speculative names are doing quite well, those can rip on you. So we are generally trying to avoid shorting names like that. And well, in fact, we always try to avoid names with high short interest. And if something that we're in does get crowded, then we do either reduce risk or exit the position.
Well, how do you see some of the exuberance in the market right now? Do you avoid certain sectors but still worry about their valuations?
Well, we generally, for us, we don't usually per se avoid certain sectors or industries. Now, that said, we've done a lot of work over the past few years in the clean tech space. And when you look at clean tech names on a long-term basis, many of them have fallen apart. But the thing is that we found that tactically, they're very difficult to be short because even on days when you don't have a lot of froth in the market, something that you're short can rip 9% for no reason at all, it seems. So those are ones that on a long-term basis, you feel good shorting, but just the short to medium term volatility can be really painful. So it's been an open, ongoing debate at Muddy Waters as to what extent we keep doing clean tech for that reason.
Now, I want to broaden the aperture here quite meaningfully, because over at Muddy Waters, you launched a new strategy. You call it the New World Order Fund, and it is a long-only strategy, actually. You're not going short here, but it is in Vietnam. I think that the rationale to this is pretty interesting. This idea here that it has to do with the flows away from China. How do you feel about opportunities abroad right now, particularly China and the Chinese economy, given that your new strategy is kind of directly focused here on the troubles you're seeing there?
So I've been very public for well over a decade. I mean, really since 2010, 2011, that I think China is in general uninvestable. And the reason that I felt it was uninvestable back then had to do with the prevalence of fraud and the fact that, at least as far as US listed China-based companies go, there's no way to hold people accountable. So that old saying, you show me the incentives, I'll show you the outcomes. On top of that now, we can layer a very hostile to business and to Western governments and to America government in the form of Xi Jinping. And that's also, I mean, this is the type of situation where we could literally wake up one day and see that China is preparing to invade Taiwan, and that could very well put the US and China on a course toward a kinetic war with each other. So that's another reason why China is uninvestable. But to go back to the way we see the world, in 2020, April of 2020, as COVID's shut most of the US down and shut a lot of the world down, it dawned on us that coming out of COVID, it was going to be the biggest geopolitical realignment since World War II, and that it would all be about the world's relationships with China. And so the question was, what's the trade? And what we settled on was that the country that is going to be the most profoundly benefited by this realignment, at least relative to the size of its markets and its economy, should be Vietnam. I think Vietnam will be ground zero for money for foreign direct investment that would have gone into China that's now looking for other homes because of the need to diversify supply chains, because of the political risks associated with China. And the reality is, I think in this new geopolitical framework, the countries that are best positioned are in general the ones that are the least aligned. So the ones that balance effectively the US and China. So that would include Vietnam, that's India, That's also Indonesia. So that to us is really the sweet spot and why we're excited about Vietnam, at least for the foreseeable future.
With that kind of a view on China in particular, I can understand the long interest here in Vietnam. But what about ADRs listed in the United States for Chinese stocks? Where do you think that they go from here? And are you looking at individual opportunities?
Well, this might seem like a cop-out, but I can't tell you where they go. I mean, so first of all, if we take a step back, I do think that substantial majority of those companies, their financials have problems. So there's probably some level of misstatement in their financials, ranges from the mild to the wild. But there's no way to enforce our laws against China-based issuers. So if you're asking why would they commit fraud, the question really should be, why wouldn't they commit fraud in that environment? So you can't trust the financials. There's no ability to enforce. And then you get this element of this capricious government in China that, I mean, it's kind of funny because I have to laugh every time the Chinese government, or really Xi Jinping, kind of changes the message and says, "Oh no, we're welcoming foreign capital now." It's like, how many times will Western investors be suckered into this? Now, part of it is that the financial industry has already sunk a lot of money into infrastructure for investing in China. So there are a lot of incentives in the financial industry to say, oh yeah, this time is different. They're not going to cheat us this time. They're not going to, we're not going to wake up one morning and find out that Xi Jinping has ordered the shutdown of companies in this space or pulled a Didi Chuxing on us. But why would it be different? I think it's a sucker's bet at the end of the day. I mean, sure, maybe the ADRs go up in the near term. But again, maybe, tomorrow morning there's been a decision that kills off an entire industry like the for-profit education industry. Mm-hmm. It's not investable. If you can find better ways of utilizing your capital at the craps table in Vegas.
Well, what about the United States here? I want to talk a little about some of the sectors that people still have concerns about: commercial real estate, regional banking. It was a number of months ago that you had announced a short on Blackstone Mortgage Trust. Where do you stand on that view now? And do you think that the outlook for that equity here will be as dire as you initially laid out?
Yeah, actually, we're more bearish on Blackstone Mortgage Trust than we were when we announced the short in December of last year. And the reason for that is initially we were really only focused on office, but we've come to the view that a lot of multifamily real estate is probably quite troubled. And so there's a decent bit of that in the Blackstone portfolio, but also a lot of these regional banks. So yeah, this kind of reminds me of 2007, when there was this zeitgeist for a little while. After the Bear Stearns hedge funds failed, there was this zeitgeist that, oh, okay, there's been deleveraging, everything's okay, and it turned out not to be. So I suspect, and I'm not a great macro guy and I'm not a real estate prognosticator, but I suspect, and this is based on kind of a lifetime of, in the markets anyway, of seeing bubbles and cycles, I suspect that we're in the early innings of a shakeout in CRE, and it's not just office, but it's also multifamily residential.
It's interesting, recently, since your initial presentation, Blackstone has come out. It has maintained its dividend. It said that a lot of firms have actually reserved less than what you have said. They have reserved, frankly, less than what you had anticipated that they would do. Are you saying things will materially get worse for them, or are you looking at other instances in the market here where you can also go short that would be tied to multifamily and properties?
Well, right now we're only publicly short on Blackstone. Now, the thing is, one of the dynamics that we were clued into as we researched BXMT before going public is that you have some of these other mortgage REITs, and KKR's is a good comp. And basically, I think there was this prisoner's dilemma where if at Blackstone they figured, hey, if nobody else is going to really true up their loans, if none of our peers in the mortgage REIT space or the CRE mortgage REIT space are going to true up their numbers and their reserves, why should we be the first ones to do it? Well, it's funny because KKR's REIT reported a week before Blackstone's, and they started the process of truing it up. Now, obviously, because we were well after the close of the year, it's not like Blackstone could have gone back and said, oh, okay, we need to change the numbers here and increase the provisions for losses. So I feel like they're out on an island now and really conspicuous by absence of true-ups or reserves, provisions against losses in their loan book. So I'm not worried about this one. It was somewhat of an atypical name for us to be short, because usually when we're short, we're saying, hey, all of this is hidden, and if investors start to pay attention to this, the company is going to crack under the pressure, and that's how our thesis plays out. They can hold the line for now, but we feel really good that a dividend cut will be coming in the second half of the year because the cash flow just will not be there to support these dividends. So I don't really have to go out on an ongoing campaign here. We're just hanging back, and we feel even more convicted at this point in time than we did in early December that the second half of this year is going to be problematic for BXMT.